The U.S. Energy Department today raised its forecast for natural gas production in 2011 by 1.5%. My next guest specializes in the infrastructure that's used to move natural gas from source to end user. Jeff Fulmer, senior advisor to Tortoise Capital Management. He's got a long resume in the energy development field. He's a geologist. Welcome to the program. Good to have you with us, Jeff.
Pimm, thanks for having me.
So, to explain a little bit about Tortoise and what its focus is.
Well, Tortoise is singularly focused on energy infrastructure, and in particular, master limited partnerships. And these are the companies that own and operate the essential infrastructure that gets oil and gas from point A to point B. I mean, we all know that society's economic well-being ties to energy and the transport thereof. And in that context, MLPs are they are front and center.
So you're talking about things like pipelines, storage facilities, or indeed even the kinds of chemical plants that would translate certain types of energy into specialized energy products, whether it be jet fuel or whether it's the kind of biobutane that's necessary to make chemicals.
Yeah, it's the pipelines that transport natural gas and crude oil and refined products. So as long as people keep demanding hot showers, we want to use modes of transport, whether they be trains, planes, automobiles, and fly around. We've got a dependency on these fuels that are being delivered by the MLPs. And most notably is what's happened with the transport of these fuels and the impact of newfound natural gas reserves in this country.
Typically from those shale plays.
Exactly. So we all know that about 7 years ago, we were running out of natural gas, and there was a lot of concern. Now the Energy Information Administration just listed a report that said our proved reserves have actually gone up beyond where they were in the early 1970s. We've got an estimated 100 years worth of supply of natural gas reserves. And these MLPs are the companies that are bringing this to bear to generate electricity, to heat our homes, and to operate our businesses.
Now, having said that, though, if the price of natural gas may be $4.30, $4.50 per million BTU, if the price of natural gas declines because there's more supply coming on stream and there's not enough demand to take it up, would that affect the valuations of these master limited partnerships, these pipelines?
Well, actually, these pipeline companies do not own the commodities that they transport. And that really is a common misconception that a lot of people have. And so it's more like a toll booth on a toll road. I mean, whether you're driving through on a Bentley or a rusted out Buick or what have you, you're going to be paying the same toll. And these companies that are transporting this natural gas, they are putting new infrastructure in place to recognize where it's being found. And then also, as we have demographic change in this country, we're going to grow population by 90 million people in the next 40 years to get it to where it's being consumed.
All right, so I gather you're bullish on a lot of these natural gas and oil pipelines. Are they being constructed? Are we getting new ones, or is there a limited field here because no one wants a brand new natural gas pipeline in their backyard? So you've got sort of a selection, but they're limited. And as a result, you're not going to be able to get a lot of new ones into the marketplace.
Well, you have to go through the permitting process. And so right now, as we sit here, the Federal Energy Regulatory Commission, the federal regulatory body that oversees these pipelines and the tariffs that they charge, they have somewhere around 3,800 miles of pipeline in some state of permitting that are waiting to get out the door. These companies, these master limited partnerships, are building those out, and the only way they build those pipelines out are after having taken a large part of the capacity and committed it to long-term contracts. And by long-term, I'm talking 5 to 20 years. And then that generates this attractive current income stream for investors. Right now, about 6%.
Now, that income stream, though, is taxed at the individual investor level, right? I mean, it's like a real estate investment trust. The income is passed through.
Well, you're absolutely right. It is like that. It's passed through, and so there's no taxation at the entity level. And so the individual investors take their fair share of gains, losses, depreciation, and they report that on their income taxes.
Do you think that that's going to change? Because, of course, the government needs more money. Is it possible that they're going to change some of the tax laws related to master limited partnerships?
Well, actually, what we've seen is just the opposite. In fact, a couple years ago, legislation was introduced to broaden the scope of qualifying assets that could be owned and operated by these pipeline companies, to include biofuels and ethanol. And in fact, these are the logical companies to take advantage and to transport alternate fuels.
All right, we got to leave it there. I want to thank you very much, Jeff Fulmer, coming to us from Tortoise Capital Management. Appreciate your thoughts on MLPs.
Thanks for having me in.